India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning and welcome to Bazaar Morning Call. Well, it's the last 7 days of the year 2024, and if you're wondering why the old war horse is back, it's because our two little ones, Mangalam and Sonal, have become parents. Many congratulations to all of us here. And there you are. And the other big reason why I'm here is the boys are absconding. It's going to be women power this week.
Absolutely.
Hi, both of you.
Lata, good to have you back in the studios. This is a nice welcome change. So I'm sure we're going to have a pretty packed next 2 hours to 2.5 hours ahead.
Yeah, looking forward to it, Lata. We've missed you on this chair.
Thanks a lot. Thank you very much. Well, actually, I'm trying to clutch at straws here, actually, as we look into the week ahead or even into the next trading day, the next 8 hours. See, the Nifty saw its worst week in 30 months, worst week since June 22nd last week. But this week, the straws I'm clutching at is first that the US inflation number, PCE inflation number, it was worse than November. November was worse than October, but it was better than what the market expected. And so we saw that rally in the US stocks. The other positive is that the US shutdown has been escaped. Both the Senate and the House have passed the 3-month spending bill. So at least that's not an overhang, a sword hanging on the market. Coming to India, there is a bit of a rate cut expectation. The minutes of the RBI MPC came out on Friday evening after markets closed, and the one member from the Reserve Bank who continues to the next policy, Dr. Rajiv Ranjan, indicates that, they are in the process of cutting first CRR cut and then wait for the data and then cut. So it looks like a cut is more likely than not. So all those are the positives, though, of course, a cut can mean negative news for banks initially because they will have to bring down loan rates. But it's positive for realty companies, NBFCs, generally corporate India, as cost of capital falls. So that could be the positives I'm clutching at. But I have to mention the negatives. FII sale, 3,600 crores nearly, even on Friday. And why was that? I mean, you just look at the data. If you are a foreign investor and as you hold the dollar, it becomes more expensive. It buys you more rupees. If you're holding it in rupees, of course, you get 6.5 per 6.7 in terms of interest. But the shares you are holding, I'll just pull out that table. If you've bought Indian shares, the Nifty is down 2.25% for December. For the year, it is up only about 8.5%. Whereas if you held dollars and US shares, the year you would have made 30.5%, and plus your dollar has appreciated. So even if you liquefied into cash, you can buy more of any other currency. Yeah. So, the temptation, when will they stop selling is what we have to wait.
No, Lata, we were counting on the fact that it's December, so holiday mood and all. No sign of FPIs being on holiday. Now, will this week be any different now that we're finally in the Christmas week, which is why I'm going with, will there be some Christmas Santa cheer finally on the street?
I think so, right? Looking at the Asian market picture, there is a rebound after reeling with losses last week.
No, absolutely. And one would hope for that because last week was absolutely crunching and back-breaking. More on the data and numbers in just a bit. But okay, so what do we have? We have positive close on Wall Street thanks to the inflation numbers that came in. And that was a very well-tracked, well-watched number, that PCE index, because that's what the Fed goes with. And the Fed is what spooked the market so much by saying we're cutting twice probably next year and not 4 times. The CBOE VIX in the US was also down quite a bit on Friday. So there was about a 23-24% drop in the VIX. And the US move was very broad-based. It wasn't just the Magnificent 7 taking the NASDAQ higher. All the indices, Dow, even Russell 2000, S&P, everything was up around 1%, a very broad move. Now, coming to the PCE itself, while the market cheered the fact that month-on-month the rise was not much, just 0.1%, which was lower than estimates, just keep your eye on the trend as well. Because if you're looking at the last couple of months, then the number has been inching higher steadily. 2.1% in September, 2.3% in October, and the November annual print, year-on-year rise, is 2.4%. Anyway, the market wanted to hold on to some positive news, so it was not just equities. You saw that in the dollar cooled off a little bit. In fact, it slipped to below 108. There was a little bit of a cool off in yields as well. The US 10-year yield, for instance, was down 4-5 points, and the dollar index even this morning is down about, just below 108. So let's see if this holds. For our market, the crunching FII numbers that Lata was alluding to, that is what's really breaking the markets back, because there's no let up in that FPI selling number. We broke below the 200 DMA on Friday, so now the Nifty is under the 20, 50, 100 and 200 DMA. The next level in question is going to be the lowest point of this correction, which is a November low, which is still a distance, about 300-400 points away from where we are. But let's see, whether we actually get there or not. The total FPI selling last week, just to put the numbers in context, is over 15,000 crores. And on Friday, domestic institutions couldn't entirely offset the 3,600 crores that was sold, which is why you had a near one-way trending market down and the end near the lows of the day. Just some points in terms of, more stock-specific action, we'll get to it. The GST meeting was a big talking point over the weekend. Now, no major announcements, because a lot of the well-tracked issues, for instance, e-commerce, quick commerce, and the health and life insurance reduction in rates, all that has been deferred. So no changes over there. So we'll sort of track that. And
what they did, right?
The popcorn.
The popcorn. They've issued a clarification on that. Yeah. So basically, if it's just salted, then it classifies as a namkeen, so 5%.
Yes.
If it's pre-packaged and labeled popcorn, 12%.
Yeah.
But if you're caramelized popcorn, then it classifies as a confectionery and therefore 18%. But the official statement says that this is just a clarification because there were some disputes arising out of the interpretation.
Yeah.
But that was a lot of
Abhishek had a problem. He showed me a packet of salted caramel popcorn.
That's true. You actually get the mix and match. I think that will be the council's next round of deliberations. So popcorn definitely made lots of headlines over the weekend. Finally, one more important headline. We all know that the steel industry has been clamoring for some support, some safeguard measures. So the DGTR has initiated, not the duty hasn't come in, but they've said that they're initiating an investigation into whether there is really dumping and how much of it, and then which countries to look at. So that would be perhaps a positive for some of the steel players. So plenty of news over the weekend as well, Rima.
Plenty of news, and the big one is it's a holiday shortened week.
Oh, yes.
So Wednesday, midweek, is a holiday for Christmas, 25th of December. There are no domestic cues to watch, so focus will be on global indicators like US bond yield, the dollar index, the initial jobless claims, the new home sales data arising out of the United States. But this week, on Thursday, we've got the December monthly expiry. So that could add to the volatility. And plus, demand for IPO is still running very high despite the severe correction that we had last week. So far in this month, there's a report which says that IPOs have raised nearly 25,000 crore rupees. And today, there's one IPO, Unimec Aerospace. We'll talk to the management. Their 500 crore IPO opens up for today, but there are lots of listings on the main board. So Transrail Lighting, DAM Capital Advisors, Mamta Machinery, Sanathan Textile, Concord Enviro Systems. These are all main board IPOs, which will be listing on the 27th. That's a Friday. But I think we should pull up Asia once again, because there are some big moves that you're seeing. So Taiwan is up close to about 2%. Hang Seng Straits is a gain of about 1%. Hang Seng is up, 0.2%, but Nikkei in Straits is up nearly 1%, and Taiwan is leading with gains 2.5% up.
In the Christmas colors, red and green, the market has had lots of red over the last week or so. Perhaps it'll hope for some green now. So let's kick things off with the equity call of the morning. Jonathan Garner of Morgan Stanley says that they have added Reliance Industries to their Asia-Pacific ex-Japan and GEM focus lists while removing GAIL. He says that they have added Reliance Industries and believe key challenges have been priced in across key verticals. From here, their analyst expects refining margins to recover after two tough quarters, and the team notes that permanent refinery capacity shutdowns have also risen. He says RIL's free cash flow engine should pick up pace as 0.6 MBPD of refining capacity shuts down in 2025 globally, and demand growth should outpace capacity addition meaningfully.
Okay, well, we live in that hope. But let's invite our guest for the morning, Anurag Singh, the managing director of ANSID Capital, joins us now. Anurag, good morning, and thank you very much indeed for spending time for us in a Christmas weekend. That's very kind of you. Well, for starters, the dollar index seems to have cooled down after a fiery last 4 days. It is at its Thursday lows. Can we count on the week at least being placid and Asian markets beginning to gain back some green?
Yeah, Latha, morning. First of all, I'm getting a bit nervous because, with the extent of knowledge you have on economics, I can't really challenge your ideas much, right? But I'll still try. So, Latha, the direction is that Europe, nobody wants to go long Europe, right? And if China is mixed and Japan is mixed. I think out there's only one place to invest money internationally, which is US. So overall, collectively, money is chasing US dollar, and why not, with a 4.5% yield. And now that it appears that Federal Reserve is going to be cutting maybe one or two next year. Two is what they're saying. Market is pricing maybe one. So yeah, difficult, right? Because look at right from 2008. Here is my broad thesis. Right from 2008 till 2020, the FI holding of Indian stocks really jumped from like 8, 10, 12% to then 22% peak. And ever since it has been dropping right now to 16, 17%. I would not be surprised if it comes down to around 11, 12% if this continues for another couple of years. But I think that should be okay because markets don't really need domestic flows. The FI flow. Indian markets at least don't really need that, right? So yeah, that seems to be the call, right? If you can earn risk-free, you were talking about it. If you can earn risk-free, why would you take a currency risk to earn just about 3-4% more in the emerging markets or Europe or rest of the world? Lata.
Okay. The issue here for us in India has been this absolutely relentless FPI selling, right? We've been discussing this for a while. The buy America, the go home trade. It's been the hallmark of, I think, since October, November, December. Do you see that changing anytime soon?
So, Surabhi, there are 2-3 takes here. One is look at the last 10 years. The collective emerging, I understand it's a basket, right? But collective emerging market as a basket, MSCI index is barely like 3%, right? That's one call. So eventually, if that 10% money is lying into emerging markets, the call is, well, for the last 10 years, either the China works, then India doesn't work, India works, China doesn't work, or collectively, if all of them work, then Brazil or, rest of the world doesn't work. So the point is now there is a new judgment coming in, which is that, well, if you're holding a McDonald's, if you're holding a Starbucks, if you're holding Apple, Microsoft, Google, all of these companies have about 30 to 40 to 50% earnings coming from rest of the world. So even holding these companies within US is a diversification for the rest of the world, right? That is one thinking, right? That's one trade. Second is, of course, everybody chases the past returns. Last 10 years has not been great if you have been either in your long Europe or long emerging markets, right? So that's the other play. And third is, it's free money. Capital will move towards whichever market shows most promise. So I think the confluence of all these factors really is playing out in terms of just parking money within US plus strong dollar, right? So all these things combined, I think, Surabhi, we need to have we need to be cognizant that at least this headwind for emerging markets is going to last at least for 1.5 years more. But I'll add 2 more points here, right? This FII selling is a bit of a distraction within Indian market, right? I think the focus should be when a Flipkart says they were planning to list in NYSE or NASDAQ, right? But now the plan seems to be changed. Now they're wanting to list in India. LG now is coming up planning to list in India. Hyundai takes away $3 billion. I think those are more pertinent and larger questions that we should raise. Look, FII money anyways was a short-term money, right? It'll come back again, right? If the right valuations are there or the dollar eases off, 10-year yield eases off, it'll come back. But this is the money that's being really taken out. This is where something I think we need to watch out for, right? Yeah. Can I add, just out of interest and just because, and this goes to Latha, we all the time we say Indian market cap is now 5 trillion, and UK market cap is barely like $3 trillion, right? It's not an apple to apple comparison. United Kingdom allows free flow of money. So if you are sitting in UK, UK pension funds have 20% of their money invested in US markets, only 4% invested in United Kingdom market. So that's a free flow of money. India doesn't allow that. And that's why the same domestic money is just trapped and it keeps overvaluing the assets within the Indian market, right? So that seems to be the challenge with the Indian space. It's not.
Your point is taken on value. There is still so much of overvaluation concerns. But I think Rima has a question.
Yeah, just to put a number on the IPO frenzy, this year, Indian markets have seen a record fundraise of 1.6 lakh crore rupees via IPOs. So it's a big milestone. And even the size of the IPOs has gone up, the likes of Hyundai, etc. Anurag, just elaborate a little bit more on the point that emerging markets are headwinded for the next 1 to 1.5 years. Are we in for a correction? And in the emerging market basket, what would your pecking order be? Because this year too, year to date, while we all thought that India is the best game in town, we're up 10% year to date, 2024. But a Hang Seng, Nikkei, even a Shanghai, they all have outperformed India with a gain of 15-16%.
Yeah. So Rima, India is still the best game in town, right? Outside of US, correct? There is, this is, I think last 6 months, I've been hearing India chatter in almost, in almost every group. Even the people who were not talking about it, now talking about India ETF and India, so there is a lot of interest, right? And partly because they understand that there are strong exits available, right? So you can get in, get out. There is this ease. It's not as shallow a market as it used to be, right? But I think in terms of the market potential, right? I think Nifty is great, right? There's no challenge on Nifty. The long-term returns, 30-year return is CAGR is 12%. Last 5-year CAGR is just about 12, 13, 14%. So it's broadly in line, right? So Nifty is fine. I think the only correction needed is, and maybe this is a bit of my thesis, Rima. I looked at Nifty 500. Look, it's hard to look at the mid and small separately because the composition has been changing. But if you look at Nifty 500 right from inception, the returns were around 10%, 9.9, 10% till 2019. It's only for the last 5 years, we've got a 30% CAGR on mid and small caps that Nifty 500 has also come equal to Nifty 50. I think that needs to, it needs a bit of a mean reversion. And when that happens, it'll lose about 1.5%, which means maybe a 20% correction from here only on the Nifty 500. So it goes down from, say, maybe 23,000 to maybe 19,000. That's the only segment which is overvalued. And that's the only segment where FIs don't have any play. So it's only domestic money just, valuing it. Otherwise, Nifty is great. I think it's exactly where it should be on the long-term potential. It's absolutely fine.
Okay, Anurag, thank you very much for joining us today with your insight. Let's also tell our viewers what we've lined up for you on our show today. So first up, coming up at 8:35, R.K. Goyal of Kalyani Steels will join in to discuss the steel sector outlook as Karnataka might increase iron ore duty. 9 a.m., we'll be joined by Harshit Kapadia of Elara Capital to discuss the key trends in the capital goods sector. 9:20, Aditya Suresh and Sandeep Bhatia of Macquarie Capital will be our market masters of the day. 9:35, the management of Metropolis Health will talk about the volume and price hike trends going into next year. A little later, 9:50, Anil Kumar and Ramakrishna Kamujhala of Unimec Aerospace and Manufacturing will join in as their 500 crore IPO opens today. And towards the end of the show, in our special segment, It's the Economy, Lata will speak with B. Prasanna, head of markets at ICICI Bank, on the MPC minutes, soaring US yields and the dollar and the impact on India.
Okay. All right. On that note, we'll take a very quick break, come back on the other side. And we have lots of stocks to, of course, get to as well. The list today includes the likes of Ultratech Cement, India Cements, Metal Stocks, Aurobindo Pharma, Suraksha Diagnostic, JBM Auto, Teamlease, AGI Greenpack and HCC, all on the back of positive news flow. Vedanta could open in the red. We'll tell you why in just a bit. Welcome back. You're with us on Bazaar Morning Call. Well, lots of stocks, as we promised, which will be in focus. That's the implied open, the bright green shade you're seeing, because a lot of the Asian markets have been holding higher as well, and the GIFT Nifty is also up and about. In terms of stocks, what's the day's list looking like? Let's get to the team. Vivek, opening with you first. Good morning. What are the stocks on your radar?
Well, good morning. That's right. So first on the list is the cement pack. So Ultratech Cement as well as India Cements relief and a positive development for Ultratech Cement. CCI, which is the Competition Commission of India, has gone ahead and approved the company's acquisition of India Cements. Remember, earlier this month, CCI had expressed a few reservations to give the nod to the open offer, citing market share concerns. But now there has been an unconditional approval that has come in. So Ultratech's open offer, which will proceed as follows. First up, they will acquire a little over 32.5% from the promoter as well as the promoter group. Open offer for an additional 26% stake will be done at a price of 390 rupees a share. The other stock in focus is Vedanta. Remember, earlier this year, the company had said that they would be demerging the company itself into 6 separate entities. However, yesterday, the company has said that the board has gone ahead and has decided against demerger of one specific business, which is the base metals business. So that will continue to remain in the parent entity or in the undertaking company. The company cites ongoing exploration of alternative avenues for restarting the Tuticorin copper smelter mine. However, the company expects the merger to be completed by Jan 25. A slight negative, but despite that, largely the demerger is largely on track.
Okay, thanks for that, Vivek. Sudarshan, first steps towards anti-dumping on steel?
Morning, Lata. So metal stocks have been focused. So over the last few weeks, you would have heard that people like Sajjan Jindal and Naveen Jindal highlighting concerns related to imports of steel flat products from China. Now DGTR, that is the body under Commerce Ministry, which comes in and looks into these issues, has put out a notification and saying that now it will investigate, and now interested parties can reply within 15 days. So what's the demand of industry? First, industry demands that imposition of safeguard duty, and the time period should be 4 years. Now DGTR will investigate that matter. So basically there are 4 stages into this. First, industry demands. Second, DGTR recommends investigation. So we are into the second stage. The next 2 stages that is left, if DGTR is confident and finds that yes, there is a real concern, then DGTR will recommend the imposition of safeguard duty. But final call will fall in the Court of Finance Ministry. But basically, normally that historically you have seen that once DGTR recommends imposition, Finance Ministry goes ahead. So we are in the second stage. 2 more stages are left. One is DGTR recommendation, and last is Finance Ministry's call.
Thank you very much for that. So watch for Tata Steel, JSW Steel, JSPL Sale. These could be the potential beneficiaries. Vinny is now joining in for the latest on the pharma sector. Vinny.
Good morning. So yes, couple of pharma companies, and one is a diagnostic company that we are keeping an eye out on. Aurobindo Pharma is the first one. Now the Curatech Biologics, which is a step-down subsidiary of the company, has obtained a marketing authorization from the UK's pharma authority, that's MHRA, and this is for one of the biosimilar drugs that is Bevcolev, which is used for in the treatment side of oncology biosimilar. So it's an important drug coming in for the company. Do not forget, just a couple of weeks back also, their biosimilar business of the company Curatech itself had received some clearance even from the European agencies for another drug. So they are seeing a lot of traction coming in from the biosimilar side, and that is why we're expecting a positive move for Aurobindo Pharma today. Moving on, also we have Suraksha Diagnostic that reported their numbers. Do not forget, it's a recently listed company. Q2 numbers seems like a good set. Revenue in Q2 is up by around 11%. Profits also seeing a growth of around 20%, while margins on a quarter-on-quarter, year-on-year basis, quarterly numbers have seen just a slight bit of an expansion of 10 basis points. But for the first half of the year, they've seen a good expansion. So first half of the year numbers are very strong overall, and margins have seen an expansion of 210 basis points, as well as in terms of the revenue per patient is at 2,099 rupees for the first half of the year, as well as in terms of the EBITDA per patient also is at 761. So decent set of numbers, good set of numbers, and expecting a green here.
Okay, all right, got it, Vinny. Thank you very much for that. Let's go back to Vivek. Vivek, AGI Green Pack and HCC on your radar. What's the news?
Well, news flow on both. First up, AGI Green Pack, the board has gone ahead and approved raising up to 1,500 crore rupees. Now, this could be either via the preferential issue, QIP, or any other mode that the board chooses to go ahead with. The other stock on the radar, HCC, an important development coming in over there. So the company has gone ahead and implemented a court-approved scheme of arrangement as far as the Switzerland subsidiary is concerned. So company stake in Steiner AG has been sold to M3, which is both a real estate as well as financing company as far as Switzerland is concerned. The company will get a one-time liquidity payout of 205 crore. Along with that, HCC will continue to own two SAG subsidiaries, which is Steiner Eagle as well as Steiner India, and there are receivables there that the company can get. Now, along with that, remember last week the company had raised close to 600 crore via the QIP route at 43.01 rupees a share. So some positive development coming in as far as HCC is concerned.
Oh, that's a relief. Thanks a lot for that, Vivek. Any positive news is welcome. Upasana, you're looking at JBM Auto and Team Lease. I hope it's good news.
Certainly, ma'am. Good morning. First up, let me start with JBM Auto, the company's wholly owned subsidiary, that is JBM Eco Life Mobility, bags order worth 1,800 crores from Ahmedabad Municipal Transport Services. Now, this order is mainly for procurement, operation and maintenance of 343 electric buses, and the company is indicated that the execution for this order is nearly within a time period of 1 year from now. Now, next up is Team Lease. Even this stock remains on our radar today as companies announced execution of definitive agreement with TSR Dashaw HR Services, and board has also approved to acquire stake in Crystal HR Services. Now, company will acquire 90% stake in TSR Dashaw and 30% stake in Crystal HR, and post the acquisition, TSR Dashaw becomes the subsidiary of the company and Crystal HR will become an associate of the company. And the combined incremental revenue is around 20 crores is what company is indicated. Hence, both these stocks remain on our radar today and expecting a green.
Okay, all right, got it. Thank you very much for that, Upasana. Let's quickly recap our list of stocks to watch. The ones that have positive news flow are Ultratech Cement, India Cement, Metal Stocks, Aurobindo Pharma, Suraksha Diagnostics, JBM Auto, Team Lease, AGI Greenpack and HCC. The only stock with the negative news flow this morning is Vedanta. All right, so that's the equity market action that we're gearing up for. What's happening with the world of commodities? Let's go across to Manisha and find out. Manisha, morning. So finally some respite in the dollar. What has that meant for commodities over the weekend?
Oh, well, absolutely. Some bit of a gains coming back in the early Asian markets right now. But we have to remember, Survi, that the trading is expected to be subdued on lower volumes. The holiday shortened week, last week of the year is all going to impact the markets here. Having said that, well, yes, the slight decline in dollar has been supportive. You have the crude oil prices now after 3% of decline in the previous week, trading 0.5% on the higher side right now. Well, the pressure continues to be in the fact because the Sinopec China, which is the largest refinery in China, says that the crude imports in China could peak in 2025 and the oil consumption in China could peak in 2027. Well, with these kind of targets and year numbers, you have seen some pressure come in the markets. And then OPEC has downgraded demand estimate for a fifth time in 2024. The G7 is exploring stricter measures on Russia oil price caps, and then U.S. could impose tariffs on China. So there's way just too much to start looking at as soon as January begins. We also did see a lot of profit taking in the previous week for metals. So whether it was gold, silver, copper, which fell 2% in the previous week, steel, which declined 3.5%. We are looking at markets opening slightly on the higher side right now. There is some opportunity buying, but the volumes have continued to be on the weaker side. So whether it can sustain or not is something that we'll see through the week.
Okay, all right, got that, Manisha. Thanks very much for joining in today. We'll take a very quick break. Come back on the other side. We'll have Prakash Diwan join in. We'll get into some fundamental stock ideas.
Welcome back, and we welcome our expert for the morning. Prakash Diwan joins us now. Good morning, Prakash, and so good to speak to you yet again. Well, can I start with steel? The DGTR has initiated the first moves towards a possible anti-dumping duty. Will you go long on metals?
Good morning, Lata. Great to be on the show with you. Yes, I think this was an area that has been a very contentious kind of a thing with most steel players. In fact, some of them have gone on record by saying that if this is not done at this point in time in their life cycle, it's going to be extremely debilitating for them to be able to grow. And my sense is the government has done rightfully. It's taken the right steps in terms of first investigating which pockets need to be addressed, and then kind of start working around the metrics around this. So it's positive. Now, whether to go long on steel or not, just on the basis of this particular trigger, the question will be whether you otherwise have a longer term orientation on the steel consumption in India going up. And my sense is it is positive for most larger players who reach scale. And particularly if you look at JSPL, JSW, even Tata Steel to a large extent, very lean balance sheets, great kind of visibility of how they're going to manage their production enhancements. So quite positive. But as I said, don't buy just on the basis of this, because this will end up becoming a bit of a short-term impulse. But you would need to have a long-term orientation, which also aligns with the positive framework. Okay.
Speaking of JSW Steel, today is a big day for the sensex, right? Because we're seeing changes on the index. They're effective today, as in they were effective end of trade Friday. So Zomato is in, JSW is out. And for the reference, just want to place the numbers. I mean, the estimates that were doing the rounds, Novama, for instance, said that this will lead to passive flows. All the, passive funds that track the nifty 50, the sensex 30, it will lead to passive inflows of about 512 thereabouts on Zomato and an outflow of about $250 million on JSW Steel. So it's a big day. I mean, it really announces the arrival of quick commerce, Zomato, food delivery. I mean, look at how it's listed. Big day for Zomato.
Just a trivia. I went back several times. Usually on the day when you enter the big index, you peak off.
Yes.
Because it's the run-up is there.
Yes.
And it may be bottoming out. But anyway, I'll leave it to Prakash.
Prakash, your thoughts? Still Zomato or Swiggy? Both? Neither?
Oh, no, absolutely. Swiggy, you can't avoid this segment. I mean, as you rightly said, new age companies are finally making their presence felt in the indices. Zomato could probably consolidate from here, where Swiggy probably, reduces the gap in terms of valuation between itself and Zomato. Remember one thing, we have been talking about competition coming in, but when I look at, for example, if you are in Bangalore, in certain parts of Bangalore, in Electronic City and all, Blinkit still doesn't make it, but Swiggy does. So, and there'll be areas where Blinkit makes a lot of difference and Swiggy doesn't. So the market is so massive. I doubt if, the competition is as hyper-intensive as it's been made to look. It's the back-end operations and all which will need to kind of be much more robust as they grow to spur this kind of a growth. So from that perspective, Zomato gives you that comfort. They've got a head start. They've done so well. They've made mistakes, learned from it. Swiggy might take some longer time to do that, but I would love to buy Zomato if Lata is right, and if this peaks out and then there is some sort of a consolidation, time correction, would love to definitely add Zomato at this point.
Okay, let's get to the other big story. The 55th GST Council meeting chaired by the Finance Minister Nirmala Sitharaman has deferred a decision to lower the tax rate on health and life insurance premiums, and food delivery charges of e-commerce aggregators like Swiggy and Zomato. They also discussed the inclusion of aviation turbine fuel under GST, but a decision was deferred since most states were not in favour of losing their right to tax it. The council, however, clarified on why different varieties of popcorn, i.e. regular, salted, spiced, caramelized, carry different rates of GST. Here's what the Finance Minister had to say.
We have our Minister of State, Pankaj Chaudhary ji, who chaired the compensation cess-related group of ministers. They have given a request to the council, which the council has accepted today, that they need more time to get into the details. So that has been given an extension. Nothing specifically mentioned about the term, but extension has been provided. Health insurance related GOM work also requires more time, so they have gone to take more time. On one or two specific grounds which I would like to put before you as to why it had to have more time. Insurance, and therefore the insurance regulator's input is awaited. IRDAI, the Insurance Regulatory and Development Authority's inputs have not come, so the GOM felt that it needed a bit more time. GOM में विस्तार से डिस्कशन हुआ है और हेल्थ इंश्योरेंस के ऊपर भी, लाइफ इंश्योरेंस के ऊपर भी, फिर भी और थोड़ा जानकारी उनको चाहिए, जैसे कि मैंने मेरे ओपनिंग स्टेटमेंट में बताया, इंश्योरेंस रेगुलेटर से भी उनको रेगुलेटर का गाइडेंस मिलना है, वो भी मिलने के बाद फिर फाइनलाइज करेंगे GOM, फिर आएगा काउंसिल में. There was this request placed on the agenda whether ATF, air traffic fuel, should be brought into the GST, because periodically we've had airlines telling us, civil aviation requesting us, that ATF should be brought into the GST. It's not been agreed on. States did not feel comfortable. They didn't want ATF because they saw it as part of the crude, petroleum, diesel basket, and therefore they said that alone cannot be taken out, and therefore that continues to remain where it is today. There was also a suggestion just ATF could be put to a GOM so that they can think whether it is worthy of consideration to be brought into the GST, but they did not want anything done about ATF.
Slew of decisions taken, but some of the contentious ones have been deferred. Prakash, on insurance in particular, so there is no relief for the insurance companies because the decision to lower the GST tax rate on the insurance premium has been deferred for now till they hear more from the IRDAI. Now, stocks like SBI Life are down 27% from its recent highs. HDFC Life is down 18% from its recent peaks. How would you approach insurance companies now? You're on mute.
As we went into this event of the GST Council, the anticipation was quite clear that there's nothing much that could come, which is very favorable. But the drop in prices on most of these stocks, the price correction that you see, has been for multiple reasons. Okay, one is of course the product mix is something which is likely to get under a fair degree of introspection in terms of what is allowed positively by the regulator, what is not, and RBI's dispensation in terms of the bank assurance support is what's impacted these two companies which you mentioned, because there is a significant dependence on that channel. My take on insurance is any opportunity which is buying into these companies because of an event which is short-term in impact, which is temporary, which is transient, is absolutely amazing. You buy into these businesses because of the long-term orientation that they have and the kind of TAM that they're looking at addressing over the period of time. Max Life, for instance, is very well poised for something where they have a strong channel which is from their advisors, along with the bank assurance of access. So you will have to pick and choose some of these businesses, but always make sure that you have a basket of at least 3 stocks out of the sector. Don't depend only on one story to narrative to kind of build your portfolio. But a couple of these names definitely make sense to buy after these dips, because things will look up in the Jan-Feb-March quarter, which is always very promising.
Okay, all right. Prakash, stay on. We were just discussing the impact on steel stocks with the anticipation there will be some sort of protectionist measure coming in, at least for some products. Let's discuss this and more with the management of Kalyani Steel. The news, just to remind you, is that India could perhaps look at imposing safeguard duty of up to 25% on steel imports. The DGTR has started a probe on the imports that are coming in the country. And also the other big news, of course, of last week was the Karnataka government likely to increase the duty on iron ore, which is mined in the state. To talk about some of these big issues, we have with us R.K. Goyal, MD at Kalyani Steels. Mr. Goyal, thank you for joining in, and season's greetings to you. Now, from what we understand, what our colleagues have been reporting and telling us is that the investigation into dumping is largely in flat products. I mean, I'm just reading out the list: hot roll coils, sheets, plates, HR plate mill, planes, and also cold roll coils and sheets. Now, first of all, I think you're largely into longs and specialty steel. Does it impact you in any way, the current specific products which are under investigation, and how big is an issue, this dumping issue, for you?
Good morning. This issue definitely impacts us also, because a lot of cheap imports are coming, particularly from China, as well as from FTA countries. Now, because of this, the availability of the material goes up in the market at much lower cost, which is definitely impacting our margins as well as our volume. Even though the passenger car industry, two-wheeler industry, they are doing well, but then the volume for specialty steel long product manufacturers are not much.
So, currently the products which I read out, which are part of this investigation, do you manufacture any of them?
You see, we do not manufacture any HR coil or TMT bar and all, or cold rolled flat products. We produce engineering steel long products, and that definitely has a big impact on the way dumping is happening in the country. Not only dumping, the metal is coming at a very low price.
What I'm asking, sir, is would you want the scope of investigation to be increased? Would you be asking that to the government?
Definitely, we are already asking to the government.
Okay. I'll, time permitting, come back to that. Mr. Goyal, I'm more worried about what Karnataka government has announced. How will it impact you if that, 100 rupees per ton is imposed and further duties on iron ore?
As such, the iron ore price in Karnataka are very high, and even in auction, the prices are going substantially higher above the base price. So steel industry and the people like us are heavily impacted. But I hope to some extent we will try to pass on to the customer. But at the same time, the dumping is happening in the country. We are finding very difficult to increase the price. So it is definitely a big issue for us.
Okay. So actually then there is a double whammy here. You may be faced with more duties on iron ore. Plus, if the anti-dumping duty is imposed, you may be able to raise prices a bit if it is a little more. But can your buyers take this double whammy? Is there enough demand?
I expect next year will be much. Once the government starts spending on infrastructure and the tenders are released, then there will be definitely demand pull will be there, and demand increase will be there and will be better off, provided the imports are curtailed.
What would be the extent of the price hike that you will need to pass on this proposed increase in iron ore duty?
So as far as you see on the face of it, it looks just 100 rupees. But in actual, the price increase is much larger because the prices of iron ore has gone up anything above 1,000 rupees per metric ton, which means iron ore alone is almost 1,700, 1,800 rupees, plus the depreciation of the rupee. That is also impacting all our imports, including coking coal, as well as ferroalloys, refractories, all such things. So in total, the effect is almost 3,000 rupees per metric ton.
And in percentage terms, sir, what would it be?
You see, in terms of percentage, it is around 3 to 4%. 4%.
Okay, Mr. Goyal, in that case, what are you seem to be living on the hope that the Indian government's capex will start. Right now, what kind of revenue growth and EBITDA per ton looks possible in 2025?
So I don't think we are expecting any revenue growth or EBITDA growth, basically because if dumping is going on and iron ore prices in the country are going up and we are not able to pass on to the customers, market so far was not great, even if market improves from here. So we are not expecting much growth currently.
You mean you will go with flat revenue and flat margin forecast? Or are you saying even lower revenue and EBITDA per ton for 25?
You see, we are already utilizing our capacity at 100% or close to 100%. We are doing extremely well as far as capacity utilization is concerned. So revenue growth will not be there. As far as EBITDA growth will be there, it depends on the safeguard duty, what is implemented, or the sentiment, improvement in the sentiment. If there is slight improvement in the sentiment, I think there will be some increase in EBITDA.
Okay. So, sir, just leave us with the full year outlook. I mean, we're down to almost the end of the third quarter also. Now, given these developments for the full year, what is the volume you will do? And if you could give us a percentage growth as well, if there'll be some growth. And EBITDA per ton, where are you now? And how do you see yourself ending the year given the issues at play?
You see, as far as revenue growth is concerned, will be flat, as I mentioned before, because we are utilizing 100% of our capacity. So until unless we have more material, which will come after our implementation of our expansion plan in Odisha, we will not have substantially higher volumes. As far as the EBITDA margins are concerned, so far it is much better than what it was. And since we are at the fag end of the third quarter, I don't think it is appropriate for me to mention any number.
Okay. All right, Mr. Goyal, we do hope 2025 brings more joyous tidings for the steel industry, metals, and for the country at large. Thank you very much for joining us.
I'm sure.
Yep.
I'm sure. Thank you.
Well, let's take a quick breather, and after the break, we will have Mitesh Thakkar and Sudarshan Sukani joining us with technical ideas. Welcome back. It's time we looked at trading strategies, and let's welcome Sudarshan and Mitesh for the morning trades. Good morning, both of you. Sudarshan, may I start with you? I can't tell you what a pleasure it is speaking to you, but I listen to you guys every day. What's the Nifty trade?
Yeah, good morning, Lata. The pleasure is all mine. It's delightful to see you and hear you today.
Thank you.
The Nifty trade is, we are seeing a gap up now. That is thanks to the US markets, which also rallied significantly on Friday. But I don't think this is the real thing. I doubt if we are beginning an uptrend. It's too early to say it. The market hasn't even opened. So we will assume it's a relief rally. And it's much better to take a position with a targeted, risk level. And that's 23,600. So far as the Nifty is trading above it, we could expect that maybe we'll enter into a Santa Claus rally. Maybe take a long position using options. Keep your stops at 23,600. This is not an assurance that we'll go up, but it's worthwhile taking a long trade with a clear, defined stop.
Point taken. I hope Santa doesn't decide that he won't check out this Christmas. He better come. Mitesh, good morning to you as well, and pleasure having you with us. What's the Nifty trade?
Good morning, Lata. And as Sudarshan mentioned, I think it's amazing to speak to you after a long, long time.
Thank you.
I think on the Nifty, as we are looking at a good gap up opening, my sense is that given the fact that the index was quite oversold, this gap up might, extend to about 23,950, 24,000 zone. I think that's the area where a lot of supply pivots are placed, retracement levels are there. And hence, I think, getting past that will be important. The initial feel is that we might struggle to get past that. And therefore, if people are stuck with long positions, as we get closer to about 23,900, my advice would be to book out, see if the market is showing strength and confirming to get past 24,000 before, looking at fresh long. So that's the way I'll approach it.
Okay, Sudarshan, can we come to the stocks now? Top picks?
Yeah, before the stocks, Lata, this is really your domain. This is not about technicals now. There's something going on in the macro atmosphere with the company results in the micro level that we don't understand. Maybe you'll probably explain it better. But for the stocks now, Cipla is a buy with a stop under 1450. Pharma is doing well. Pharma usually does this. When the whole market is collapsing, pharma is going up. So Cipla and Lupin is another buying opportunity with a stop under 2115. I have two intraday shorts. Consider these shorts if the market rally starts fizzling out. Crompton is an intraday short with a stop above 395. And MCX, which has been seen a significant rally and is now facing resistance, is an intraday short with a stop above 6430.
Okay, Sudarshan, for what it is worth, our Nifty earnings disappointed in Q2 in the quarter gone by. And everyone's not so sure about the earnings growth going forward because of this very discordant noises coming from the US as well. There is a very good double-digit 13 to 17% earnings growth forecast for next year, but everything is up in the air depending on how the trade wars and the tariff wars pan out. And for this big FII selling, we have been speaking about it, Surabhi has detailed it. If you stay in dollars, you're getting more bang for the buck. One day you get 85, the next day you get 86 rupees. So people don't want to stay in rupees, one because the currency is falling and another because the stock prices are also falling. It's so much more advantageous to stay in the US. That's the limited explanation for now, but let's hope that it consolidates at some point and people think enough is enough, we have overvalued stocks. But now to Mitesh, your picks, Mitesh?
Yeah. So I have more of sell calls, but it will be conditional sell given the fact that there's a gap up looming in front of us. So ACC on a bounce back, sell around 2085, 2090 with a stop at 2130 for targets of 2000. Chola Finance is also a sell around 1200, sell with a stop at 1230 for targets of 1150. And Lalpath Lab, if it breaks Friday's low, which is 2935, then sell with a stop at 2960 for targets of 2870. And one buy, which is CDSL, which I would suggest buying at a slightly higher levels because there's a gap up. So buy around 1870, 75 if you get it. Keep a stop below 1849 and look for a target of 1920.
Okay. All right. Mitesh, thank you very much for that. Sudarshan, thanks to you as well. We'll come back a little closer to market opening. Quick break right now. Come back on the other side. And then at about 9 o'clock, we're putting the spotlight on the capital goods space. Harshit Kapadia of Elara will join in to talk about what lies ahead, because that's the big hope in the market. A pickup in government spending. What will it spell for capital goods stocks in 2025? Okay, welcome back. You're with us on Bazaar Morning Call. So just to talk about the next sector in focus, by the way, it's 9 a.m. We'll start getting our pre-open rates any minute now. The expectation is that because of the green across Asia, the implied open has been a little positive, and hopefully in the absence of intense FPI selling, maybe the market will manage a little bit of a bounce back. And the first rates at least have a bit of green on them. So let's see how that goes. But before we get to Harshit Kapadia and that conversation on capital goods, let's actually talk about Siemens. Now, we all remember what happened to the stock on Friday. It was a slam dunk on Siemens, really. So what are brokerages making of it? There was commentary from the company that was talking about maybe not too much of a pickup in some of the expected capex increase. Let's go across to Hormaz for all the details. Morning, Hormaz.
Morning, Surbhi, and very, very sharp price action, as you just mentioned, on Friday. To shed more light on the price action first, it was the biggest single-day drop that the stock saw in the last 6 months. And on the volumes front, it was 17 lakh shares that saw Siemens that were traded. It was not usually such a very, very liquid stock, but that trading volume on Friday was equivalent to the last 8 sessions put together. So that was the kind of volumes that we saw on Friday, and only 32% of the total number of shares that were traded on Friday were marked for delivery. Of course, there was a marked difference in the total number of shares traded as well, which is even still, it was the lowest in terms of delivery volumes for the week as well. Now, on the F&O side, there was long unwinding seen on the stock, which means a decline in both price and open interest, almost a 14% drop in open interest that we saw on Friday. What brokerages have to say, UBS is neutral, an 8,000 rupee price target. What they are saying is that the adverse short cycle and the back-ended commentary that they have given with regards to the businesses on the railway business has a negative read-through for ABB as well as CG Power to a certain extent. Elara has an accumulate rating on the stock, but they have cut their price target to 76.70 from 8,000 earlier. But they say that Siemens is set to benefit from a multi-year capex cycle courtesy 3 factors, and that is its diversified portfolio, a technological edge, and the support that it gets from its parent company. And it is expecting a 22% earnings CAGR over FY24 to 27. Now, Nuvama has a hold rating. It has also cut its price target to 7,000, and what it has said is that the limited near-term triggers that Siemens has in the HVDC and the railways business calls for caution on the stock, and hence the cut in price target. So it'll be interesting to see how the stock moves after that 10% drop on Friday.
Okay, thank you very much for that. In fact, let's get in Elara's Harshit Kapadia, Vice President Analyst. Remember, as Hormaz said, they've cut the target price on Siemens to 76.70 from 8,000, but they still have an accumulate rating. So Harshit, talk about the sector per se, a top-down approach as we enter into 2025, and what's in hold for what's ahead for Siemens.
Morning. So as far as cap goods sector is concerned, we are expecting that the government capex, which was not doing that great until the first 7 months, will see a pickup mainly in Q4 because they have to exhaust the budget. So that's the first trigger that we see on the government side. As far as private capex is concerned, given that the geopolitical scenario is not in the very positive mood, a lot of capital expenditure in terms of capacity addition has been postponed by certain large core industries. Now that is giving some negative commentary on more capex, which we're expecting the private sector will be a little bit slowed, a little bit back-ended towards maybe second half of FY26 as things starts to normalize. That's where a little bit of negativeness is there.
Okay, Harshit, good morning. Thanks for joining us. I read your economist Garima's report, very convincing that, that PSU capital goods stocks normally rise 2 years after capex picks up for the government. Just take us through that argument, and therefore, will you all be bullish on some PSU capital goods stocks?
Yes, so the historical evidence suggests that whenever we see a stronger capital expenditure coming from government side, generally it takes time to convert it into ordering trend because a lot of tenders are there. And hence we're expecting this large capex which has been rolled out. We'll see, mainly this year, given that the elections were due, a lot of capex was withheld. And now we are going to see a lot of tendering activities to pick up now, given the Q4 is very nearer. So from Jan onwards, we see a lot of big ticket orders in sectors like defense, railways, as roads and highways should be there. So that's our take.
So which stocks, which would you go by in the PSU basket?
In the PSU basket, since I look at cap goods sector, what we like is Hindustan Aeronautics, Bharat Dynamics, Bharat Electronics in that space. On the railway side, we like RITES. The other sectors that we generally talk about in the PSU space, we like SBI, we like GAIL in that particular space as well.
Yeah. Okay, so PSUs are your pick for 2025 when it's about playing government capex. Just throw in a word on valuations as well, Harshit. I mean, with this market correction, because anyway, the private sector names were anyway trading at, I think, 90 times, some of them 100 times the ABBs and Siemens of the world. Now, with this correction, have valuations at all come into some kind of a comfort zone? I mean, so Siemens fell 9%, right? But they say if you want to buy these stocks, you have to wait for such corrections to come in. So for someone who has a medium-term view, would you look at the MNC names at all, or would you stick with PSUs? Do you have, apart from the ordering, do you also have valuation comfort there?
Yes, so within the MNC space, yes, valuation comforts have started to come in. Earlier, it was at around 80 times. Now, both the stocks, if you look at a 2-year forward, they are close to around 65 times. So that's been a reasonable level. One can start looking at this name, but I would still, be bullish on the government-related expenditure. So even in MNC space, who has a higher exposure on government-related capex, for example, Siemens has a higher exposure compared to ABB. So I would prefer Siemens over ABB in this scenario.
Okay. What about power? I mean, it's partly private sector, obviously, and partly government. We saw NHPC and all announcing some moves in Bihar during the investor meet. Any of the power-related PSUs that you like?
So within the power space, I think my analyst Rupesh Shanke, he looks at the power sector, and he has been bullish on NTPC and Power Grid within those names. On the smaller side, he likes SJVN is what we understand.
Okay, got that. And just to complete the point, Harshit, on public sector capex picking up, and that's your play in the traditional capital goods arena. Just tell us about the kind of big orders, so sort of we keep that on our calendar for 2025. Which are the specific products, systems, subsystems, HAL you mentioned, so I guess defense will continue to be hot. Just, in terms of some more qualitative color on the kind of big orders, the pipeline.
So on the defense side, we expect ordering trend on submarine to start. There were 3 submarines order which were anticipated. It was a Scorpion class coming from France, which was where Mazgaon docks will get benefit. So that's one order. On Hindustan Aeronautics, we're expecting a large order for 97 numbers of Tejas and additional which was required. The size expected to be upwards of 60,000 crores. Then we are looking at a loco order of 6,000 HP, which could be ordered where it may go to private sector. The ordering trend for even metro would also pick up. We are sensing orders for Bhubaneswar metro coach also to be tendered out very soon. These are some large names that we recollect.
Got it. No hope of private sector, demand push Is it all only, you're betting only on government expenditure? You don't see demand itself pushing, say, housing, cement demand pushing any capital goods? No?
We sense sectors like renewables, data centers, semiconductors, or the new age sectors where private capex has started picking up. But the core industries, whether it is steel, cement, auto, they would be a bit on the softer side as far as demand pickup is there. So it's more new age sectors we are sensing the cap goods industries move towards at this point in time.
And even there, Siemens is warning that it's okay, it's happening, but it's a little slow. Even some of these sectors like data centers, etc. Got it? Very helpful, Harshit. Thank you. So we'll watch out for those submarine orders, the Tejas, like you said, and a couple of major metro projects as well. So that's the big pipeline on the government side. Thank you. Thank you for joining in.
L&T, because the Ministry of Defence, it came 2 days back, so L&T will be a stock you should watch. Ministry of Defence has signed a 7,629 crore contract for Make in India artillery guns. So L&T is another stock in the space you should keep your eye on.
L&T and of course, Bharat Forge. I mean, they've had this.
No, I mean, this is a
running...
recent order.
Yeah.
It was end of week news.
End of week news, yeah. Okay, all right, got it. So let's quickly move on, quickly take stock of the market. So thanks to the fact that there's been this big surge in Asia and we've been slammed so hard last week, the Nifty is showing you some green, 150 points higher. So Darshan told us that as long as it's above 23,600 thereabouts, you can maybe play for a bounce. So let's come to some final stock ideas and advice as well. Sudarshan?
Well, consider Cipla with a stop under 1450.
Okay, and Mitesh?
I'll go with the long on CDSL if you get it on a mild decline, say around 1870-75, and look for targets of 1920.
Thank you. Let's get to Indigo.
But just a minute, would there be any shorting ideas? I mean, if Mitesh and Sudarshan are there, Mitesh, any shorting ideas?
I had three, Lata. I had more of shorting ideas. ACC, if it gets closer to about 2090 zones, 2100 levels, I think a good time to go short. Similarly, Lal Path Lab, if it starts breaking below Friday's low, then I think because the structure is weak and it might not participate in the bounce back. So that's the short idea as well. So sell below 2930 here. So I have short ideas as well.
Okay. And Sudarshan, anything now after seeing the market?
Yes, there are two ideas which I gave and they are standing there. MCX, which is an intraday short, and Crompton. So, but the point is that after the early morning rally is over, then you look to short.
Fair point.
Okay.
Thank you very much, both of you, and we will, of course, touch base later on in the morning.
Okay, just want to place two stocks on your radar. In the pre-open, they are showing a lot of interest. One is India Cements with the CCI approval coming in. Just remember the open offer price. The open offer price that Ultratech has put out is 390. Stock closed at around 350 thereabouts, and now it's up about 22 rupees higher, 7% higher. And the other one is JBM Auto, large bus order, 1,800 crores. So that stock's up about 4% as well.
And now it's over to Vinny for Interglobe Aviation. Vinny.
Good morning. So yes, we have Interglobe Aviation that will also be in focus. We have Elara that has upgraded the stock to a buy from a previous sell rating. They've increased the target price to 5,309 rupees per share from previous 3,847 rupees. They've revised FY25, 26, 27 EPS estimates as well. Now, what are the factors and why are they positive? What are the tailwinds that they see coming in for Indigo as well as the sector as a whole? One, demand they believe will be strengthening in the next couple of years from FY25 to FY28. They're expecting a CAGR growth of around 12% for this sector. Addition of new airports in Mumbai and Delhi from April 25 and onwards over there will be something that will be supporting the demand growth for aviation sector. Indigo's Pratt & Whitney aircraft is returning to operations, so that will be a positive there. Terminal expansions in Bangalore, Chennai, Ahmedabad, Kolkata over FY27-28 will support demand, as well as a shift away from railway traffic. Moving towards air traffic is something that will be a key positive in terms of the trends that will be supporting the growth, especially for Interglobe Aviation.
Okay. Thanks a lot for that, Vinny. And incidentally, the stock is starting 1.7% higher. Of course, these are pre-opening rates. And pre-opening, the index also is all comfortably up about 0.5%, still underperforming Asia. But it's as good, and we are taking it with both hands. Bajaj Auto, Sudarshan has a few thoughts on this. Sudarshan, why are you watching the stock?
So Bajaj Auto last week has launched a new Chetak E-Series starting at a price of rupees 1.20 lakhs. And today Investec has come out with a note mentioning that it has a buy call and a target is 13,550 per share. That is implying an upside of 50% from current levels. What did it say? It says there's a sharp fall in the cost of production for electric two-wheelers, and at the same time, company has been gaining market share. It has mentioned few growth drivers. First, growth in domestic two-wheeler portfolio led by ramp-up of CNG volumes, electric two-wheelers and Triumph motorcycle. Second, it believes there might be a recovery in export markets, and uptick in electric three-wheeler portfolio will also aid the growth. And at the last, it also finds the valuations after the recent fall that Bajaj Auto stock has seen, valuations attractive. That's the reason it has a buy call on the stock with a target price of 13,550 per share.
Thank you very much for that. If you pull up a 2-year chart of Bajaj Auto, it had a fantastic run from January of last year, 2023, to almost October of 2024, when the stock price rallied from levels of 3,800 all the way to 12,700. But after peaking off towards the end of September at 12,700, we've seen the stock correct close to about 30% from its peak level. And now you've got a bullish note coming through on Bajaj Auto on the EV momentum. And the stock price is, the target price is 13,500.
Yeah. At the moment, of course, everything in the sensex is doing very well. So this news will be taken. But the two-wheeler sales, as Sudarshan himself had once told us, for the month of December has been weak over previous December. I mean, year on year. Seasonally, or things do drop off in December. But even comparing with previous December, it's been a very bad sale. There goes the bell, and the market continues to open in the green. It's a good 0.7% higher for the sensex and the nifty. 23,730, 740 holding. That's good news. Up about 0.7%. Mid caps also up about 0.7%. And the Nifty Bank up. It's the best of the three. There you have the stocks coming up for you. You have almost all stocks in the green except for Apollo Hospitals, which is a tad in the red. So that's good going. The best of gains is coming for JSW Steel. Well, it usually happens when you're exiting the index. That's when all the selling has already happened and the stock begins to see a bit of, short covering. Otherwise, metal stocks otherwise as well have been doing well. So I think the DGTR going in with some initial investigation on whether an anti-dumping duty is needed is casting a positive pall. The positivity is also then on NBFC stock. Shriram Finance doing well. And then that could be explained by the fact that we have a likelihood of a February rate cut. If you looked at the statements coming in the MPC. Among the other stocks that are doing well, Trent, M&M, Bharti Airtel, Wipro, L&T, Axis Bank, many of the stocks that we did discuss. I think the IT stocks are a late recognition that Accenture gave us good news. So there's a bit of green over there. But actually green all over. So it is really a top-up, top-down purchase of the Nifty that we are seeing at this point in time.
Absolutely. A nice 200-point bounce. You haven't seen that in a while, given how weak the market has been. Do remember to take note of Reliance. Remember Jonathan Garner, the Morgan Stanley call, saying that refining is going to get much better and the company will see a pickup in its fortunes in 2025. There are a lot of refinery outages, so therefore that will all help boost GRMs in the core business, 1% up on Reliance Industries. The insurers are sulking because nothing came out of the GST meeting. Slight red, not too much, but about 0.5%, 0.25% decline on HDFC Life, ICICI Pru, Lombard, SBI Life, Max. All of the insurers are down because the wait for any kind of rate cut on health and life insurance, that continues. Just some more stocks to speak of. By the way, the mid-cap market is also quite healthy, in step with the large caps almost, with a 0.5% gain on the indices. I go back to India Cements, 8.5%. Again, just a reminder that the open offer that Ultratech is going to launch is going to be at 390 rupees. And now the deal has gotten cleared, so lots of excitement around India Cements. In fact, a lot of the other smaller cement stocks, look at Star Cement, look at Orient Cement, very interesting. Even Kalyani Steel, we just spoke to the management right now. They're hoping that even their products will be covered with the safeguard, investigation that's underway. So some of these material stocks doing quite well this morning.
Some more. So MobiKwik, one of the recent listings, is practically double now. 279 was the issue price, and now the stock is at 524, a good 7.5% up move. It's day 2 for IGI, International Gemological Institute, and it started off with strength, 4.5% gain. Across the board, steel-related names are higher. So, pull up a sale that's up close to about 2 to 3%. JSW Steel 2.5%. JSPL also higher by 2.7%. Order wins are pushing up JBM Auto. For JBM Auto, it's an 1,800 crore order win. And for Sterling and Wilson, it's a 1,200 crore order win. Vedanta is another one where the parent company has decided not to demerge the base metals business. So Vedanta has a green tick, not by a whole lot, but Vedanta is up and about in trade. Sagility deserves mention. For the last couple of days, it's been rising. Last week, Jefferies initiated coverage on Sagility. Target price set was 52 rupees. On the way down, you've got some insurance-related names, as Surbhi pointed out. So Star Health is down 2.5%. SBI Life, HDFC Life in the red. Siemens, after the 10% downtick, has lost some more ground, 2% gone on that. But on the whole, the opening has been strong, in line with the strength that we're seeing across the Asian market, about 3/4 of a percentage point higher on the sensex and the nifty, and a very strong advanced decline ratio.
Okay, all right. Let's just take final stock of prices before we move on. It's really metals all the way, and that trend is intact on the nifty. JSW Steel, Tata Steel, Hindalco. Not only for the steel guys, obviously the safeguard duty is a point to note, but also remember internationally the dollar's finally taken a bit of a breather. So perhaps in the holiday shortened trade, some hopes and expectations that internationally as well you'll see some revival in prices. So sentiment rub off over there. And Reliance is gaining more ground now, about 1.5% up on Reliance. And the banks are absolutely in step with the Nifty, so they're helping stabilize things this morning. HDFC Bank, SBI, a lot of the biggies up about 0.7% to almost 1%. So nice green-looking screen for now.
Absolutely. I mean, at least it's holding up for the first 5 minutes. Let's keep our fingers crossed. And the entrant into the sensex, Zomato, is now seeing red. As always happens, everyone's already bought into it. Today is the profit-taking day. And short covering, one can see on JSW Steel. There is the metal news, of course, or rather metal hopes. And as you move out of the index, all the selling is perhaps over, and JSW is in a spot of green. So it's kind of switching the colors, as it were. Well, it's time now for our special segment, Outlook 2025. How will Indian markets perform in the coming year, which is just about 8 days away? What are the growth headwinds? What will be the top stocks and sectors to look out for in 2025? To talk about all that, we have two special guests with us in the studio. Aditya Suresh, Managing Director, Head of India Research, and Sandeep Bhatia, Managing Director, Head of Equity India at Macquarie Capital, both of them. Sandeep and Aditya, thank you very much indeed for joining us. Well, Sandeep, let me start with you. As your report says, the consumer has decided to take a nap, looks like, not much consumption. Very nice phrase. But what's the sense? You think it's bottoming out, and as the government spends and the Rabi harvest comes in, would it be buy time in 2025? Consumption stocks.
So consumption has been weak, and that's something which has been seen in earnings. I would think that consumption should slowly inch up. There's not going to be a quick rebound. That doesn't happen, especially for the broad swath of consumption that happens in India. But definitely, this means that the worst is behind us. Whether to buy the stocks, I would think we should wait for longer correction, both in the market and for consumer stocks specifically, before we buy them. But the worst of consumption probably is behind us, and it's a slow uptick.
It's not yet by the fear.
Yes.
Okay. Just to add to what Sandeep said, I think we think about consumer as three parts, right? The top end, I think the characterization is things are okay, but momentum is softening. I think the middle category is where there is a problem, and I think that problem may kind of persist depending on kind of incomes and inflation. Rural, I think, is an area where I think we are seeing at least some green shoots, right? So things have been kind of soft. Company commentary is speaking a bit more optimistically. The data as well is starting to improve a little bit. So I think, in those three categories, within this top end looks relatively better place, but in there, momentum is softening. But a lot is already in expectations. That's, I guess, a problem for these consumer stocks.
I mean, people will always argue on valuations, right? Sandeep, I remember you've been cautioning, on the markets for a while now in our previous conversations. In fact, I think the middle of November when we had you on, you were saying you wouldn't be surprised if you see another 10% downside from here. And in individual stocks, it's really played out. beyond the consumer, like when you look at the year as a whole, I mean, the whole hope is on this government capex picking up, right? But beyond that, is there anything that can turn the tide?
What can turn the tide is that if India manages the Trump presidency well. India is one of the few countries which, besides the US and China, is entirely domestic driven. But for the first time, I would say, the way the world is positioned, the US is actually pivoting in a major way. The US has been the consumer of last resort. The growth model, which India did not implement in the 70s and thereafter, was export to the US, be allied to the US. And that has been a very slow and painful path for India to take. Even now, we are primarily a domestic-driven economy. But we are now definitely looking to be more closely connected with the US. And if the US pivots away from being the consumer of the last resort, then there is a growth challenge for the rest of the world, and including India, especially where we are most exposed to, which is in IT services. H-1B visas could be something which the US government can take up. So all these issues, if Trump comes down with a sledgehammer on tariffs or on some policies which make it difficult for our businesses to operate, there could be a correction in the market. There would eventually be a reset, and Indian companies will come out stronger and better, but there would be definitely an impact on the markets.
But just to
1 minute, with your
that,
permission, Aditya, you tell me. I would respect Victor Schweitz a great deal. The Macquarie Capital thinker. What does he say about the global, fund movement? There is a point. I mean, dollar cannot go on 108, 109. As well, yields in the US, the US stocks. When does he see the inflection point when the US exceptionalism will stop?
The short answer is in the short term, he does not see that inflection. The strong becomes stronger is kind of the mindset. Yeah, and that I guess is a problem, right? So the stronger dollar is going to be a broader problem for emerging market fund flows. Within that context, India has not seen any meaningful fund flows in the past 3 years and 4 years. So is that really going to be a tailwind here for markets for the next 12 months? We don't see that necessarily.
Okay, sorry, Surabhi.
No, so I was actually asking you something on similar lines, that in fact, the fact that we've been more domestic driven, doesn't that actually help us and work in our favor in case we get this tariff blow? And while I take your point completely on the US being the consumer of last resort right now, it's doing so well, right? That's why the money is rushing back there. So again, what should we, beyond IT services, from the global arena, what should we be fearful of? I mean, on the flows point that Aditya made, you see any changes there at all?
So a strong US dollar is bad for all equity inflows into emerging markets as an asset class. The other thing that we have to be fearful of is how the geopolitics is shaping up. I've been saying that for almost 2 years now, that actually more than earnings, geopolitics is the driver for a lot of things which are happening, which have been broadly good for India. So if something happens in the neighborhood which puts India under any geopolitical pressure, then that could be something which we need to worry about. Not that I expect it to happen, but we have seen unexpected events happen all through 2024 and before.
So let's talk about what investors should do, right? You spoke about some headwinds. There are 5 of them which you've outlined, which will test the resilience of the domestic liquidity. But you still have some buy ideas. In this rich bazaar, bottom up, you still find 25 buy ideas. Can you talk a little bit about that?
So let me just go through that a little bit, right? So in that report, what we're basically saying is that there are these headwinds for us to kind of work through, as you kind of pointed out. But it's not to say that India as a market, we can't find bottom-up buy ideas. So within our coverage, there are these 20, 25 odd kind of ideas which we still find and we still like, and it's attractive. At a sector level, when I kind of aggregate up where we are a bit more optimistic, it ends up being we're far more optimistic on telecom and IT compared to the benchmark. We're a bit more optimistic on healthcare as a space. We end up being neutral on financials. We end up being meaningfully negative on consumer, right? That's kind of a key underweight here for us. Industrials is about kind of in line. So that's kind of the broad kind of flavor of kind of how we are positioned. We can touch on the specific stocks, but yeah, sector-wise, that's how we are positioned. But a lot of it is also down to what's already in earnings expectations. and the 2-year forward story, is that going to be lifted upward or downward? And that has a big influence on kind of what is mentioned.
Either of you can take this, but would you all prefer mid caps? Because all the selling is coming by the FIs in the big ones. So even in pharma, for instance, would the preference be towards
I think the
nifty?
general mindset, Latha, is more just specific and bottom up rather than a general broad brush of mid cap, large cap. But you're completely correct that foreigners, as an example, the banks, that's been the biggest kind of overweight position. And despite the valuation support, there's more selling which is kind of coming through. So it's an interesting dynamic which is at play. But I wouldn't characterize as sell all mid caps. I think there are quite a few kind of quality ideas within there which we like. Yeah.
Okay. And to top it off, and this is something you mentioned in the report, there is, apart from the FPI selling, there is VC selling, there is MNC parent selling, there is Indian promoter selling. Just a sheer supply of paper. How much does that concern you folks? And I mean, we've seen this in the past. I don't know if this is the same again, that when you have this amount of paper hitting the market, usually coincides with a bit of a top. So on the market as a whole, what's the market call for 2025? And what about all this additional selling in India?
Yeah, so just on the supply of paper as well, it's clearly in response to the excess liquidity which is there in the market, right? Just to contextualize this again, domestic liquidity, even if you follow the NSE pulse, I mean, when you look at DII plus individuals, it's about $70 billion in this year, right? Which is a fairly large number. That's only the first 10, 11 months of the year. So there is more there with that. It's not been foreign. Now, when you think about the primary and secondary kind of supply, it's still behind this, right? So to the extent that this level of domestic liquidity holds, this pace of kind of primary and secondary activity can actually be absorbed, right? Now, having said that, I think the broader things which we think about is, in fact, just 2 points. One is that the average ticket size of these transactions down 75% in the past, say, 2 years. That, I think, is a red herring on its own. And point two is that only about, say, 5 or 10% of these proceeds is going to fund growth capex.
Absolutely. It's all people
Everything
cashing
else
out.
is luxury property, right? Or something else somewhere. That is, again, a red herring. But I think the broader dynamic is that I think it's in response to these deep liquidity dynamics which have manifested itself. And as long as that holds, we could see a repeat of this next year as well, right?
It's all boiling down to domestic liquidity then.
Yeah.
Yes. So just to add to what he just mentioned, I would welcome the widening of the market in terms of the IPOs which are coming through. There are some good businesses which were not listed, which have been listed, and they will get, will see further additions. We also saw a process when the GDRs and ADRs were coming that we were exporting our markets out. That's not happening. So structurally, that's a good thing. What is, as he said, pointed out, is a worry figure. And, someone I know has said that, at the beginning of the bull market, the investors have the cash and the promoters have the vision. And now, at the end of the bull market, the promoters have the cash and the investors are left with the vision. So in the end, I think the way the IPO markets are happening with everyone cashing out, it's clearly that valuations are very rich and and a good point to cash out. And therefore, this can continue as the liquidity flows can indicate. But in the end, it only points down to the underlying theme, which we've been saying for some time now, which the markets are expensive. Earnings has been slowing down. A lot needs to unfold in the first 2 months of next year. We need to see where the Trump presidency is headed. We need to see where India can position itself over the next 2 to 5 years before we see stabilization of the markets and valuations and an entry point emerge.
Okay, you have given us one big cue. Wait for the promoters to stop selling. That is an indication the market is not overvalued.
But has so many IPO KYCs. She's our IPO expert here. She'll tell us about the kind of money that's just
I have Rima's question for you. IT stocks, I mean, after Accenture told us, would it be a buy?
And especially when you said that IT is at risk because of global factors, but as a house, you are bullish on IT.
So I think it should be framed in the context of what's already in earnings expectations, right? And when you see IT sector, there has been a downdraft of earnings in the past, say 6 months, right? And so at least our analyst is far more optimistic about demand. And the call is that you're going to see revenue beat on the upside, plus there is marginal expansion. So he's selectively optimistic again on the IT space. It's not like we're going to buy the entire sector and buy all the large caps. So we do like a few mid caps, we like the TCS, HCL, these type of things, persistent in the mid caps. So yeah, but that's one area where we are a bit more optimistic relative to where expectations are at.
Okay, so that's IT. So let's recap. I mean, we've taken all the headwinds that you've played out on board. Apart from IT, where do you see relative safety? Or I mean, when you say you have to be buying when eventually there's a correction, time or price correction. So
I think banks are a good place.
Okay.
Banks' valuations are not as demanding. I think the other thing which anyone who's been long enough in the market realizes is that the banking sector was the Achilles heel of India. In the last 10 years, there's been significant positive structural improvement, in addition to the fact that the fisc of the center has definitely improved. In fact, I would think that other than the, people give a lot of importance to the China plus one factor, but these are the domestic factors, whether it's the Indian fisc, whether it's the banking sector, and also the relative political stability that India has seen, and therefore consistent policy direction in a broad sense, both for economics and for the foreign policy. All that has contributed to India emerging as an important pole in the emerging market universe. So that is something which I would think more than just China plus one or anything like that, and which is why even if there is some growth slowdown which is happening in the market, I would think that if these factors continue, India's markets may see corrections, but that would not mean that they would be very deep.
Okay, but would you expect the earnings downgrades to continue for the next 2 quarters, and is it priced in? He spoke about growth slowdown.
No, so I think that's one thing which we would definitely want to continue to caution, that in the past 2 quarters, we've finally started seeing more misses than beats in estimates. The shape of the earnings graph for India has been a big support factor over the past 2 years, right, where our estimates kept being revised upward with that markets were supported. I think that has to be reset. There has to be a reset, right? So expectations remain still far too optimistic. When you look at the kind of 2-year kind of growth outlook, it's about 15% EPS growth, which is, I think, disconnected from kind of what we are seeing, at least on the bottom up.
And what should it be reset to, from 15%?
I think if it would be, even if we get 10 or 12, I think that'll be a good outcome.
And is that but are you expecting that for FY26?
For FY26, yeah. So we are at between 10 to 12%. But even that, I think there is an element of optimism in those estimates already baked in. When I look at kind of what's happening on a quarterly basis and look at the trend there, it's not consistent with that outlook. So there is hope to get to that 10 to 12%.
No.
But it has the risk. There are downside risks to that.
Another year of single-digit earnings growth can't be ruled out.
We would not rule that out.
Oh.
But then it's always been about a market where we cut, roll forward, and keep the faith in the 2-year forward story, right? So the narrative about the growth outlook also matters.
Okay.
But for FY26, yeah, we are more in the camp of more
But how do you hold the flag of, the India story with a high single-digit kind of earnings growth for the next 2 years?
So we are more in the camp that, as a market, we do pull back.
Yeah.
There is a reset which is required. The how much is clearly a function of domestic liquidity. Yeah. So why we are where we are as a market, a lot of it as a multiple as well, is driven by this domestic liquidity dynamics, right? So to the extent that the resilience of this liquidity is tested, then then the downside is probably going to be a bit more, a bit more profound.
Sandeep, you want to add a range to that? Last time you told us maybe 10%. Widely, I mean, wide range, perhaps for calendar year 25?
So I'm not in the camp that domestic liquidity can always be a savior. It can actually cushion the impact of earnings disappointment. So I would think that another 10% correction in the market in the first half of the year, depending upon what happens in terms of what Trump does. Actually, as I said in the very beginning, it actually is externally driven for a change in India, the market, rather than internally driven. But it would be something which if India sees a growth rebound coming through, which it can and which it should, that couldn't be easily be cushioned with domestic liquidity. So we have to see.
Your choice of stocks is all very much defensive. Look at that. Sun Pharma, Lupin, all the pharma stocks. And then you have TCS, HCL Tech, Birla Soft, all the tech stocks. Tech and pharma, classic defensives. You're not betting on the capex cycle. You're not betting on the L&T types. Don't see it on the anvil.
No, look, I think, again, it's got to be framed in the context of what's already in expectations, right? So industrials, when you look at what's in earnings expectations, there is a lot of growth which is already built into the L&T estimates,
price.
right? And so at best we're meeting numbers. There is confidence on that theme, and I think this first half blip which we saw, we still think that the first half government capex kind of slowdown was more a blip. So we're still behind the theme in full. But I think it's more that bottom-up list again is more in terms of what's already in expectations and where there is a bit of upside in the multiple. L&T does feature in that list of kind of, or within our top, say, 15 odd stocks in there. And that's more, but the proxy again is more about the confidence of the theme than it being about earnings being revised upward.
Yeah, fair enough. I mean, there's power grid. So you do have capex stocks. Yeah, sorry.
Okay, so just to try and be optimistic, though, we have to be realists, and you've laid out, all the concerns. But if one to just talk about the optimistic upside, the upside risks to a lot of the estimates you've sort of laid out, what could be the upside risk that perhaps stops this relentless FPI selling for one?
So I think 2025 is election light year. We just have Delhi in the beginning of next year, and then we have Bihar coming at the other end. I don't think it can throw up very negative surprises. People already have expectations on both elections. And then we have rest of the year to keep batting and hitting some 4s and 6s, as I would think. I think if Trump comes across and can not be so negative for India and for the rest of the world, he's a deal maker, and I would trust his instincts that he would actually be ready to make a deal with whoever decides to do that. We would have stability on the broad global macro. And if that happens, India's underlying growth story will re-emerge very quickly. By the second half of the year, most of it will be visible, and the markets will start. Even before the earnings come through, once we have stability on these fronts, the market can easily rally from the second half. So it's actually, my view is that the first quarter is very important. After that, we will know where we stand.
And in the emerging markets, where is it that Macquarie has the highest conviction in the first half and in
India.
the India?
Yes.
Despite the FI
at last.
But we have Macquarie thinks that the US, India and Japan, and as you said, in emerging markets, it's India.
It's India.
So these are the countries which are have the most degrees of freedom to deal with anything that's thrown at them.
Okay, let me push my luck then. Top 3 conviction calls in India.
I'm going to refrain from the stock ideas. Okay. That's there on the report. It's probably flashing on the screen. But yeah, I mean, as a market, and to start to what Sandeep is saying, I think the characterization is really about 2 steps forward, 1 step back. I think now the next 6-12 months about the 1 step back before you go 2 steps forward. Within that dynamic, our mindset is defensive. In that defensive construct, our positioning is in IT, pharma, and financials.
Okay.
IT, pharma, and financials. And hoping for a better second half of 2025. That's where some of the positives maybe
second quarter.
Maybe second quarter itself, so it's not that bad. Yes.
Good.
Nice.
So if we push you hard enough, we get an advancement. Thank you very much.
Thank you, gentlemen, and wish you a very, very happy 2025 to you, your teams, and of course, all your near India ones.
Happy holidays.
Happy holidays.
Thank you.
Thank you. Thank you very much for joining in. So now let's focus on the diagnostic and the healthcare space. What are the sector growth expectations? Should we expect any price hikes? How will volumes shape up? To discuss all this and more, Ameera Shah, promoter and executive chairperson at Metropolis Health, is now joining in. Ameera, thank you very much for joining in. Give us the top 3 priorities for Metropolis for 2025. You just closed out last year with an acquisition of Core, which enhances your presence in oncology. Looking ahead at next year, the top 3 things that you're focusing on.
So we're very excited about 2025. I think, like you said, the top 3 priorities, and Core was our first move there. We'll continue to expand into the north and east of India. These are markets, while we may be number 3, number 4 in these markets, but we would certainly like to move ahead and become, significant leaders in the market. So we'll continue to sort of keep building market share in the north and the east of India. So that's certainly priority number 1. I think overall, with Core coming on board and cancer testing becoming a very prominent part of our portfolio, we will really expand into new kinds of testing that center around oncology and other specialty areas, and continue to build the specialty area in a very significant way as well. So I would say that's certainly number 2. And overall, I mean, I think the expansion of the network, we're currently in about 700 towns and cities. We do believe we'll get to 1,000 towns and cities next year with network expansion. And we would also like to continue to focus on the productivity of the networks. So I think these three will continue to be the key KPIs, from a financial and a operational perspective. From a quality and a scientific perspective, is obviously always staying ahead of the curve, being a pioneer in all kinds of new innovative testing, and ensuring that we continue to remain the most respected scientific brand in the country.
Okay, you actually touched on all the things I wanted to ask you about. So thanks for that overarching answer. But now for some details. After you all bought Core Diagnostics, your total amount of specialty percentage has jumped from, I believe, 37 to 41. Will that be a strategy you will pursue to increase the amount of specialty products? Any more M&A on the anvil? And, by the end of next year, what would the specialty contribution be?
So certainly, I think the idea of buying a specialty oncology player is to continue to grow that piece of it, and we'll continue to do that into next year as well. Core as a business has been growing at about 22% CAGR, which is not including COVID or any sort of one-time contracts. And we would obviously like to see that growth sustain or grow faster as we move forward. And obviously, getting profit out of that acquisition is going to be Metropolis's cup of tea in terms of really executing any consolidation or operational synergies that we think are possible to be able to really make it into a profitable enterprise and get that value bit into our books. So yes, I don't think we have a number in mind that we're going to take the specialty portfolio to, but we would certainly like to continue to see progress every year in the right direction.
Ameera, hi. Thank you for joining in, and season's greetings to you. I want to know something which has a bearing, both from a consumer standpoint and from the business standpoint, which is the competitive intensity and pricing. Typically, I think you folks take a price hike once every, 2 odd years, 2-3 years or so. There was a hike taken in January. Will you be looking or considering one again in 2025? And how intense is competition now?
Look, honestly, I think when new health tech players came in and started using pricing as a tool to try and acquire consumers, we always knew that can work only as far as the wellness segment, where consumers are not sick and are therefore making a decision based on convenience and price. But frankly, on the illness side, which is 90% of the market, we don't find that consumers make a decision based on price. And that's the reason why, your scientific edge, your trust, your capability to provide large test menu, all of those things matter much more than pricing. We had taken a price increase on B2B and B2C. The weighted average of it was about 3 to 4% in Jan 24. And while it was 6% on B2C, it was about 2-3% on B2B. So therefore, an average of about 3 to 4%. And I think in Jan 25, in 25, we will again consider whether we would like to do it or not. I don't think we have a decision yet, but it's certainly something that we are considering as we go along.
Consider it, and I know this is still under discussion, would it be similar to the quantum of hike taken in 24? If at all you go through it, what's the thought process right now?
No, probably not. It will probably be a little bit lesser than what we would go through in 24. Again, like we said, we don't have a decision on anything yet. But at this point of time, the way we usually look at it is that sort of every couple of years, if you're able to get sort of a 5% kind of a number going, then you're sort of in a reasonably okay shape. So we would look at it, if anything, as a 2-year sort of plan rather than an annual plan. And if we have done something last year and we do a little bit more this year, but it's sort of the weighted average of it has to be sort of a 2-year.
Ameera, just talking about that one point, that you want to expand from 700 towns currently to 1,000 towns by the end of next year. And focus on improving the productivity also along the way. How would you measure the productivity? What is it currently and what is the KPI to measure it? What is the goal on that front? And secondly, as you expand into tier 2, tier 3 cities, how will it affect the kind of return or productivity? Because it appears that some of the tech-led players are gaining market share there and are pretty strong.
Not with my information. Actually, I think, like I said, that the sectors are quite specifically divided into more wellness and illness. So actually, if you see on the illness side, it's the incumbent players who are more brick and mortar. And of course, all of us are omni-channel now, so you really can't decide them as online player, as offline player anymore. Everybody is omni. We get 20% of our revenues from digital channels as well. But I think as you go deeper into the markets, your wellness component actually is not as high as the component of the cities. Because the knowledge, the awareness that you need for wellness from the consumer side is much lesser in tier 2, tier 3 markets. And that's where illness testing actually is predominantly important. There, if you actually see, it's either the local brands or the national brands, which are in the top 3 players. We certainly don't see any of the original online players in the top 3 in these markets at all. So, I think from our perspective, when we look at productivity, you look at your collection center network, and usually there is a maturity stage for it. So it takes about 4 to 5 years for a collection center to get to a mature stage. So what we do is we do an aging analysis of all our centers, as we have been, scaling up our centers rather quickly in the last 7-8 years. And we look at an aging analysis, and we look at what the revenue per month is from a collection center based on the aging and where it should be. And then you keep sort of working to sort of get it to the level that you believe it should be benchmarked at. And that's how you sort of assess the productivity per center. You have to remember, you can have 10, 50, 100, 200 centers feeding a lab. So there is no limitation on the number of collection centers that you can set up that can actually be the spokes attached to a particular lab. But the labs also function in a 3 sort of guided structure, in our 3-tier structure in our company, where you have the satellite labs who do the top 100, 150 varieties of tests. And a collection center would send the sample there. Whatever can be done there would be done there. From there, it would go to a regional reference lab, which would do about 500 varieties of tests, which would usually be in a major city. And from those regional reference labs, we would go to the global reference lab, which is in Bombay, where we do 4,000 varieties of tests, if there is any test that needs to be done. But all of this logistics is at the back end. So from the patient and consumer perspective, they get all their reports, at one time with one sort of envelope, or on their email, without knowing sort of which lab it's being tested in. And that's really for us to manage at the back end.
Okay. Just some nitty-gritty numbers. Industry volumes are growing between 6 and 8%. What will yours be in FY26? And what will your margins be?
So if you look at industry numbers growing, there's really no third-party data. You can only look at what the public companies are growing at. And what we are finding is amongst the public companies, we're probably the faster growing. We are at about 8-9% volume versus some of our peers are actually at 3 to 4% volume. So the range, is that wide at this point.
All right, Amira, we'll leave the conversation here for now. If you don't speak again, wish you a very Merry Christmas, Happy New Year, and look forward to more conversations in the next year. Get into a break. On the other side, the management of Unimec Aerospace and Manufacturing, their 500 crore IPO opens for subscription today. We'll get chatting with the management. Welcome back. Unimec Aerospace IPO opens for subscription today. It's a 500 crore IPO, which comprises of 250 crore of a fresh issue and 250 crore of an offer for sale. The company has already raised 149 crore rupees via the anchor book. To talk more about the company, the IPO offering, Anil Kumar, Chairman, Managing Director, and Ram Krishnan Kamajhala, the whole-time Director and CFO of the company, are with us on the show now. Thank you very much for joining in. Mr. Kumar, first, if you could just tell us a little bit more about the company, what is it that you do and what is the opportunity? So as of last year, you were a 200 crore kind of a top-line company. What is the overall, total addressable market for the products that you manufacture?
Okay. So thank you for giving an opportunity in CNBC, and I'm Anil, Chief Executive and co-founder of Unimec Aerospace. So as Unimec, we have two offerings as manufacturer. One is aerospace toolings for airframe as well as aero engine segment. and precision components for aerospace, defense, and energy sectors. So we do high mix, low volume, complex assemblies in our factory. So that goes into aerospace and other sectors. So when it comes to kind of total address, as you see from offering, one is tooling, which is probably about more than 18-20 billion kind of an opportunity in terms of USD, and for precision component, it's a very massive opportunity, which we have kind of where we have kind of only scratched the surface, because this segment is an emerging segment for us. We started about two and a half years ago, where manufacturing complex precision components as well as some sub-assemblies. So this is probably more than 150 billion kind of an opportunity, I guess, and it is only growing, especially considering a lot of promotion in India, making India forward the world on the defense and aerospace sectors.
Okay. Well, Mr. Ramakrishna, good morning, and thank you very much, both of you, for joining us. Only half the money you're raising is going to be used by the company. The rest is an offer for sale. Now, in that 250 crore that you will get, what is the capex plan? You've raised your debt. Will you retire that 75 crore of debt? As well, will you be better off this year because you're largely exporting with the rupee, depreciating? Is 25 likely to be a better year for you in terms of revenue growth?
Yeah, sure. I think next year, definitely it's going to be better year in terms of the kind of growth opportunity what we see, and as well as it's helping. The money is also coming into place, and the capex expansion also happening. So the 250 CR, as you mentioned, the fresh issue is going to be utilized for three purposes. The capex expansion is going to happen. Where 80 crores and all. We are going to use it for the capex, and then working capital objective we have. And yes, debt repayment also we have, as we have raised capex in the first half of the year, and that is going to be repaid once IPO money comes. So yeah, it's a kind of good considering the opportunity what we have, and it is completely aligned with the capex plan what we planned. It's definitely is going to be a good year for the coming year.
Mr. Ramakrishna, you said you all are a low volume, high value business, and we've seen your margins expand from 21% in FY22. You're already at 40% in the first half of the year. What led to that? Is there scope to expand margins? And also the margin difference between aero tooling, which is most of your revenues, and the new area that you've entered into, precision components?
Sure. So the segment what we have selected is high mix, high mix, high complex and low volume category, which is a kind of a niche segment which many of the manufacturer in India, not focused. Even for that matter, I think China also never focused on this segment, which is a kind of complex by nature, and volume wise, definitely is a kind of low kind of opportunity because it's a large assembly kind of activity. So by nature, this segment, tend to give more margin, and more so it is the aerospace sector. So, but yeah, this year, first half of the year, the margins are slightly better than last year. Having said that, I can't assure it's going to be the same manner. But it's a kind of probably a mixed variation also could help us in the first half of the year to make more margin. Having said that, the next couple of years, like the more focus is going to be on precision component as well. So precision component comparative to aero tooling, the margins are slightly lower than that. Because of slightly more volume business is that so we do see a slight drop in margins when compared to aero tooling, but while next 4 years 70% contribution of revenue comes from aero tooling and 30% only comes from the precision component. So yeah, the math works like that.
Okay, then why are you selling out, Mr. Anil Kumar? You're selling out 85 crore and Ramakrishna 45 crore. It's doing well, good margins, you're saying, even if slightly lower because of precision tools. Why are you selling out?
Oh, see, originally,
Anil,
So
yes, Anilji.
Yes. So originally we didn't have intention to kind of sell it out because the amount that we have to raise in the main board, there is a cap actually at either 10% of the equity or probably a 400 crore if I'm not wrong. So where our fresh issue that we kind of forecasted came up to only 200 to 250 crore. Then the remaining amount, if you have to kind of go up to 10% of dilution. So that can only be accommodated in the OFS. So, though it's not very lucrative for us, considering the growth in the future, but we didn't have any other way.
Okay. Mr. Kumar, what will the contribution of precision components rise to, and what is it currently?
So, precision components is about 15 to 20% currently in the company, approximately, and then it kind of goes up to 30-35% in the coming years.
Coming in 3 years, 5 years?
Yes, 3 to 4 years.
3 to 4 years. And this capex that you're raising some money which will be used for capex. When will that come on stream? And what will be the incremental revenue because of this? And is there a utilization number for you? What's the need for the capex?
You want to take up, Ram?
Yeah, sure. The capex, there are three, phases. I would say, the first phase already in H1, is already happened. Maybe a couple of weeks or a month ago, we already some capex already come, and the next phase of capex, post IPO money comes. So once we pay the money, by before March, the next phase of capex is going to be infused, or it's going to be come in. The next year the balance capex is coming. So in terms of revenue linking, if you see, while I can't give any number in future, but I can give an indication that the revenue per month revenue kind of thing, is definitely going to increase significantly as the first half of the year, capex is already infused, which is a kind of one-time, capex increase, compared to previous one, and the coming capex, which is going to be before March, which comes, that is going to be almost 1.2 times, kind of capex, addition is going to happen, and the balance is going to come up, some portion is going to come up the next year. So we would definitely see kind of 2 to 2.5 times kind of, monthly revenue growth, or kind of revenue growth from that perspective, because the capex expansion is 2 to 2.5 times is going to happen in 12 to 15 months time.
Okay, that sounds very impressive, and I think investors will be very glad to hear that you are selling it as a heart wrench, because the rules require that at least 10% have to be listed in the first round. That will be, of course, a positive that you really want to stick with your company. All the very best for the year 2025 and for your IPO as well, Mr. Anil Kumar and Mr. Ramakrishna.
Thank you. Thank you very much.
Well, that's the word from the IPO. So the barrage isn't stopping, and this looks like one where the promoters want to stick with the company and are only selling out because of the SEBI listing rules, the minimum public shareholding rules. With that, let's shift our gaze back to the markets. At the moment, the green is mostly held except for the mid-cap stocks, which of course did not lose as much, so one can understand the profit-taking coming there. The fact that the green has held on in Sensex and Nifty is a bit of a hope as well, 1% higher on the bank Nifty. Let's invite Mitesh Thakkar to tell us what he would do after the first hour of trading. Good morning again, Mitesh. What's the strategy now, Nifty and stocks?
Good morning, Lata. So, while you had a gap up, it's about 150 points higher, 170 points higher, but there's no sign of reversal as yet. So I'm still waiting it out in case we get a negative signal. Then we'll look at doing some bearish strategies via buying put options and selling out of the money put options. But till then, I think holding our horses. But on the stock side, again, it's a slightly negative kind of a trade which I have. Hudco is breaking down today, despite the fact that market is up. Hudco is down about 1.75%. So sell here with the stop just about range high of 244. Keep a stop at maybe 245. Look for a target of around 220, 2 to about 221 on the downside. And the other one is Kalyan Jewelers. Disclaimer that I have some very small positions over here, but here the breakout comes in below 718, 717. So it's trading at about 722. So sell below 718, keep a stop at about 730. Look for targets of 690.
Mitesh, very quickly, are you disappointed that the mid-cap index has given up its morning gains? The small-cap index is down 0.5%?
Not really, because the structure is in weak. We were oversold, no doubt. So there could be this bounce back. Might have a bit more strength, a few more hours to try and attempt. But till we get a move beyond 24,000 and 24,150 zones, I don't think there's a bigger reversal happening. So maybe a few days of pullback and choppy activity. But I think on higher levels, on rallies, I would want to still explore more of shorting opportunities.
Thank you very much for that. Get into a break. On the other side, Manisha Gupta will join in to talk commodities. Stay tuned. Welcome back. Let's talk commodities now. And Manisha is now joining in. Manisha.
Well, thank you for that, Rima. I'm looking at an asset class which doesn't take a holiday, works 24/7. It's not going to be off even during Christmas and New Year's. And we've seen that happen in various previous decades as well. Well, I'm talking about cryptocurrencies right now. One of the assets which also has done very strong in sense of returns in this year. Talk about Bitcoin, and we've seen an all-time high of 108,000 on December 17th. It's trading around 95, 96,000 right now. But even with those kind of gains, it is 145% on the higher side in this year until now. Well, there are various reasons on why the cryptocurrencies have surged, but Bitcoin, which is the number one and has the largest market cap within the sector as well, is gained because of Bitcoin halving, which happens every 4 years. And every Bitcoin halving year, every fourth year, you will see prices continue to run up. It was in the month of January 2024 that we saw approval of Bitcoin ETF come in, and then subsequently Ethereum ETF as well. And we've seen billions of dollars come in for this. And because of that, you have seen institutional adoption due to regulated and accessible framework. So major names, funds, mutual funds actually have started giving their clients a way to invest into cryptocurrencies. Also, when you look at the institutional investors, they now own nearly 20% of all Bitcoin ETFs traded in US. So that would tell you on the kind of volumes that we seem to be looking at here. Well, if you look at the numbers as well, 2024 also had its bits of ups and downs here. If you look at the crypto frauds, while 2022 was 3.7 billion and last year was really high, this year as well you have seen $2.3 billion of frauds, rug pulls happen into the market. For 2024, the major names that you saw were Bazaar, Radiant Capital and DMM Bitcoin, where you saw tragedies happening. Well, the markets also are looking at 60% of tokens that were launched being malicious in 2024. Of this, 27% also faced rug pulls. And then 10 meme coins actually make up for $1 billion of market cap. So this is all that money that perhaps seems to be playing on whim right now. But 2025, and the markets do believe that it could be a stronger year going forward. One, because the US president-elect is a pro-crypto stance there. The other thing is that there is an open discussion now about using Bitcoin as a potential tool to repay US debt as well. That has been another reason that took the prices much on the higher side. And then there are various countries which are adding Bitcoin within their reserves as well. After El Salvador, we've seen Bhutan do it. Tonga, Paraguay and Panama also seem to be considering adopting Bitcoin as a legal tender. Well, going forward, it's going to be about wider adoption of real-world assets that could be supportive for this technology. And then there are 10 ETF applications which could also be coming up for review from CEC, and these come in from Solana, XRP, etc. So 2025, especially the first quarter of the next year, could be bringing in a lot in sense of positivity for the cryptocurrencies there. When it comes to Bitcoin, while we already have done 100,000 on the higher side, but 2025 promises to see much higher numbers there. Well, Tim Draper, for one, says 250,000 by the end of this year. Standard Chartered has been quite bullish on Bitcoin, 200,000 from them. Bernstein has put 200,000 off a level as well. And Investing Heaven talks about a big range. Of course, that is what comes in with volatility in sense of cryptocurrencies, 75 to 170 on the higher side as well. So much higher gains continuing for 2025 is the belief as of now.
My God, that's mouth-watering. Huge gains. I mean, 250,000. What does that mean in terms of taking away money from other markets? Thank you very much, Manisha, for that very interesting analysis of what might happen to the market that never sleeps, cryptos. Time now for a break. And on the other side, it's our special segment. It's the economy. I will be connecting with B. Prasanna, the head of global markets at ICICI Bank, to discuss the MPC minutes, the soaring US yields, the rising US dollar, and all that, how it impacts India.